Welcome back to The Explainer. Today, we are unpacking a pretty fascinating world, the invisible architects of our economy. We're going to pull back the curtain on the massive institutions that operate entirely behind the scenes to manage our money, influence our job markets, and literally dictate the cost of our everyday lives.
Think about the money sitting in your bank account right now, or, the cash in your pocket. What actually determines its value? Why does a loaf of bread cost what it does today compared to, say, 10 years ago? Well, the answer almost always traces back to a very specific, wildly powerful group of institutions, central banks. They are the ones actually holding the reins of the global economy.
Okay, let's dive right in. Here is our roadmap for today. First, the power of central banks. Second, meet the Eurosystem. Third, who makes the rules? And finally, the independence debate.
Section 1. The power of central banks, the architects of the economy.
All right, before we get into the weeds of the European system, we've got to establish a baseline understanding of the tools at their disposal. The primary tool these economic maestros use is monetary policy. Now, this isn't just some abstract economic jargon, it's the specific set of interventions a central authority uses to actually guide the money supply. By pulling these levers, central banks directly impact interest rates, business credit, and the total economic growth, the aggregate output of an entire nation.
And for the major central banks, all of those tools are typically aimed at one very specific target, 2%. That is the magic number. The primary objective for major central banking systems is maintaining medium-term inflation right at this 2% mark. We call this price stability, and it matters deeply. Why? Because it directly protects your purchasing power from eroding too quickly while still encouraging a healthy, growing economy.
Now, they weren't always totally obsessed with inflation. In fact, their roles have evolved massively over the centuries. Way back in 1668, the Bank of Sweden was established, basically just to lend money to the government. Then, booming global trade led to the founding of the Bank of England in 1694, which we generally consider the de facto origin of modern central banking. Over the centuries, their functions expanded to act as a lender of last resort to failing banks and to safeguard overall monetary stability. Fast forward to June 1st, 1998, and we see the establishment of the European Central Bank, created specifically to handle this totally unprecedented transition of multiple nations into the Eurozone.
Section 2. Meet the Eurosystem, the European blueprint.
So the European model is incredibly unique, but heads up, it does come with a bit of an alphabet soup of acronyms that we're going to need to untangle. But before we do, just think about the sheer scale of this monetary union. As of 2024, exactly 20 out of the 27 European Union member states have adopted the euro as their currency. Those 20 countries make up what we call the Eurozone. And to join this exclusive club, a country must meet a really strict set of economic and legal conditions known as the Maastricht criteria.
At the very top of this whole structure, you've got the European Central Bank, the ECB. But they definitely don't work alone. They collaborate closely with the national central banks, or NCBs, of the individual countries. Together, the ECB and the NCBs of the 20 countries that actually use the euro form the Eurosystem. Meanwhile, the broader European System of Central Banks, the ESCB, includes all 27 EU member states, promoting broader cooperation even with those nations who haven't actually adopted the euro yet.
Section 3. Who makes the rules? The architects of money.
To see how all of this translates into real-world action, we really need to uncover who exactly is sitting in the room making these massive financial decisions. The ECB relies on three main decision-making bodies, each with very distinct functions. You've got the Governing Council, formulating the big-picture policy, the Executive Board, handling the daily operations, and the General Council, acting as a broader cooperative forum. Let's break down each one to understand exactly how this power is distributed.
First up, the ultimate maestro, the Governing Council. This is the main decision-making body responsible for actually formulating monetary policy to achieve that crucial 2% price stability we talked about. They meet in Frankfurt on a fortnightly basis. And how do they vote? It's actually really fascinating. They use a monthly rotation basis for the national governors. So the 5 largest economies, Germany, France, Italy, Spain, and the Netherlands, share 4 voting rights, while the remaining 14 countries have to share 11 voting rights. Next up, we have the Executive Board. These are the folks managing the day-to-day operations of the ECB and the Eurosystem.
Unlike those rotating national governors in the Governing Council, the 6 members of the Executive Board hold permanent voting rights. They're appointed by the European Council and make decisions in their own personal capacity, which really helps insulate them from immediate local national pressures. And finally, we have the General Council. This body includes the ECB president and vice president, plus the governors of all 28 EU member states. Yep, even the ones who don't use the euro. They handle statistical information and standardized reporting, but they don't actually get to vote on monetary policy. In fact, by statute, this is a completely transitional setup. It's essentially an advisory body waiting for the day when all EU states fully adopt the single currency, at which point it'll just dissolve entirely.
Which brings us to Section 4, the independence debate, politics versus economics.
So arguably the most fascinating part of this whole topic is the inherent tension between political control and central bank autonomy. Over the last 4 decades, both the theory and the hard data suggest that monetary policy is just way more effective when a central bank operates independently. And this independence relies on 2 main pillars. First is goal independence, meaning the bank defines its objectives completely without political influence. Second is instrument independence, which is the total freedom to choose exactly which policy tools to deploy to hit those goals. But you really have to ask, should unelected officials hold that much power? Let's look at both sides impartially. The case for independence argues that politicians face intense pressure to artificially boost the economy right before an election just to win votes. This causes an inflationary political business cycle. An independent bank, guided by pure expertise, prevents this boom and bust roller coaster. On the flip side, the case against independence points out that an economy actually performs best when monetary policy and government fiscal policy are fully coordinated. Plus, critics point to the theory of bureaucratic behavior, arguing that unelected officials might prioritize maximizing their own power and prestige at the expense of the wider public interest.
Despite this debate, the global trend has strongly favored independence, and actually, the ECB is engineered to be even more independent than the U.S. Federal Reserve. They protect this autonomy through 4 strict firewalls. There's institutional independence, meaning they legally cannot take instructions from any government. Personal independence ensures secure tenure, so members can't just be fired for making an unpopular choice. Functional independence guarantees they actually have the tools to pursue price stability. And lastly, financial independence ensures the ECB entirely controls its own budget, meaning no politician can threaten to defund them if they disagree with a rate hike.
As we wrap up this explainer, I want to leave you with a bit of a provocative thought. We've seen how central banks evolved, how the ECB is uniquely structured, and the absolutely massive firewalls built to keep politicians out of the boardroom. But considering that these decisions dictate the value of your money, your ability to get a mortgage, and the overall health of your country's economy, ask yourself, should ultimate financial power rest with the politicians we elect to represent us, or the independent experts trained to balance the books? It's a really delicate balance of power, and one that shapes the world we live in every single day.